made mention of some basic terminologies in forex trading. So we explained some key words that mostly we use in this forex space. So today we are going to continue from where we left off, and yesterday I guided you guys through registering a broker, and I made mention of the fact that before you can start trading, you need to register or sign up with a broker. So the broker is just an institution that allows you to trade the forex market. Okay, so you sign up with a broker. You can create either a real account or a demo account, and then you can start from there. So mostly with the demo account is for newbies who want to start their journey in forex trading, and they just don't want to invest real money yet because of how volatile the forex market actually is. So you can start learning how to trade with a demo account, and if you find your edge in the market very well and you are confident to get in on live, then you can actually register or sign up with real money. Okay, so we're going to continue from where we left off yesterday, and I hope you are going to learn something new today as well. Okay, so let me just share my screen and show you what we have. Okay. Alright, so I'm currently sharing my screen. If you can see my screen, kindly let me know. You can type in the chat box if you can see my screen. Right. Okay, so the last time I was talking about certain orders that we place on the forex market, or certain trades that we place on the forex market. So I spoke about the fact that you can either have an instant execution, that is, you either buy or sell, or you can execute a pending order. So now a pending order is basically an order that you set when price has not hit your desired target yet. Okay, so let's say you want to sell at a specific price point, but the current price is not close to where you actually want to sell or buy. So this is where you actually set a pending order, so that when price get to that price point, price will automatically execute for you. So there are four main types of pending orders. So we have the sell limit, we have the buy limit, and we have the sell stop, and then we have the buy stop as well. So yesterday I spoke about the fact that with the sell limit order, it is a pending order to go short or to sell a currency pair at a level that is higher than the current price. And then with the sell limit, you are looking to sell at a price level that is lower than the current price. So let's say we have a chart right here. Currently we are running a trade right now. I call it trade in my community, so I think we are running in close to 50% profit at the moment. So let me just open a fresh chart. So let's say, for example, you have a chart right here. Okay, let's say for example you have a chart right here, and let's say you are looking to sell. This is where this thin blue line that you see on the screen over here represent the current price. Okay, so currently the price trading at the moment is around 2,413.67. okay, and then maybe you are looking to place a pending order to sell around an area over here. Because price has not gotten to this level yet and is currently trading at this level, you set a pending order at the price level where you want to execute your sell. Okay, so because the pending order or the level you want to sell is higher than the current price, you are going to set a sell limit order over here, because the order you want to place is higher than the current price. So that is what the purpose of the sell limit order does. And then when you want to sell below the current price, then it means you are going to set a sell stop order. Okay, you are going to set a sell stop order. So the opposite is actually for buys. If you are looking to buy at a level that is higher than the current price, or you are looking to buy at a level lower than the current price, you are going to set a buy limit order. If you are looking to buy at a level that is higher than the current price, you are going to use the buy stop order. So we also demonstrated how to use the MT5 and then also connect your demo account to your MT5. Okay, so this is how the MT5 platform actually works. So anytime you want to set any of these limit orders, whether buy limit, sell limit, or buy stop or sell stop, you can go to your quotes. That is where your various instruments that are available for you to trade is actually listed. Then maybe you can tap on it after your analysis has been done on the TradingView platform. You just tap on it, you tap on new order, all right, and then market execution means you are executing an instant order either to buy or sell at where the current price is actually trading. But this time around we are looking to buy or sell limit. So any of these are the various pending orders that we can use. Mostly we use these four main: the buy limit, sell limit, buy stop, and then the sell stop. Okay, so these are the four main pending orders that we are going to be using. And then if you want to execute an instant order whether to buy or to sell, we are going to select the market execution. So let's say we are looking to sell at a price point of maybe 2416 over here. Looking at my cursor, currently is trading around 2414. So you can see clearly that price is trading below our intended target or our intended price level where we actually want to sell. So all you need to do is go to your MT5, as you can see on my screen over here, and then you tap on new order. This is the gold chart XAU USD over here. You tap on new order, all right, and then you select your sell limit order, and then it's going to give you a space where you want to enter the price point above the current price level that you want to sell. So we have 2416, that is the price level we want to sell, and then you set your stop loss. I explained stop loss to you to be your risk management tool. Whenever price goes against you, this is a way to stop you out so that you don't lose more money than intended. So you set your stop loss, that is a level that you are going to set in case price decide to continue buying even though you are looking to sell. You are going to also set that one. So let's say we are setting our stop loss around anywhere above our entry, because we are buying around 2416. Our risk level would be maybe somewhere above the entry, which is maybe 2417.84. so you just want to type 2417.84, and then your TP is your intended or your potential profit target that you want to make. Because you are selling and you're expecting price to drop, obviously your TP would be somewhere around way below the current level where you've actually analyzed. So let's say at this line, this is where maybe our TP would be. So you look at the price level over here, which is 2409.16, and then you're going to type it over there. Okay, 2409.16 as our TP. So this over here is where we're going to set our lot size. Okay, so all you need to do is just set your lot size. We're going to talk about lot size very soon. All right, then we just execute our trade. 2416. Right, So TP2409.16. Then you place your order. Okay, so once your order has been placed, price will then wait for, let me just switch it up. Once your order has been placed, you would see some markings on the screen. Let me just zoom it up a bit. Let me check. Let me just zoom it up. Yeah, so you can see clearly over here that our pending order has been set around here. So price has to come all the way and tap into our pending order, or the price point that we've actually set, before it will start executing our trade for us. And this is our stop loss level. So in case price gets here and then it doesn't sell and then it continues buying, then it means that at that instant we'll be losing money at that instant, because we've executed a sell position around this area. Okay, so when price starts moving up, this is the farthest point that price has to get to. Then we can actually, price is going to what, close the trade for us, because this is where our risk level has been set, so we don't lose so much money than intended. Okay, and then the TP over here is our intended profit. So let's say price gets to this point and it starts selling and gets to this point, it's going to close our trades and then add our profit back to our balance. Okay, so this is how we set these pending orders. So we have the instant execution, that is market execution, or we can either have the sell limit, buy limit, sell stop, and then the buy stop. If you are still confused, there is I've still made this course available on the link, so if you can check the resources, you still have access to the course so that you can understand further. Okay, so because of time, let me just head over to lot sizes. Okay, so lot size is a very important term that we use in forex trading. Okay, so whenever you buy or sell, okay, how much money money you are going to make, or how much money you are going to lose, it will be dependent on this particular term, which is the lot size. So the lot size determines the number of currency units that you are willing to buy or sell. So if you can remember, when I was setting the limit order, you remember I entered a certain number, a certain decimal number, 0.01. that is the lot size. Okay, so we have four main types of lot sizes. Okay, so the lot size determines the number of currency units that you will buy or sell. Okay, so we have four different lot sizes. The first one is what we call the standard lot. A standard lot means that you are actually buying 100,000 currency units, and then the value for a standard lot per pip movement. Okay, so if price moves just a single pip, you are either going to earn $10, or and if it moves 10 pips in your favor, you are going to earn $10. If it moves 10 pips against you, you are going to lose $10 on that particular trade. And then we have the mini lots, which means that what you are actually controlling 10,000 units of currency, and it's donated by what, 0.1, and then the pip value is what, $1 per pip. $1 per pip. And then we also have the micro lot, that is the lowest. We also have the micro lot, that is the lowest level, the lowest lot size you can actually enter, which is 0.01, which means you're actually controlling 1,000 units of currency. So if price moves in your favor by 1 pip, you are going to earn 10 cents per pip. And then we have the nano lot, which is currently not in the system, that is anywhere below 0.01. Okay, so we have our standard lot, which is 1, we have our mini lot, which is 0.1, and then we have our micro lot, which is 0.01. Okay, so we want to also calculate how much money I'm willing to lose, how much money will I make whenever I enter any of these lot size. And mind you, this lot size is not just fixed. So let's say if you are using a micro lot of 0.01, you can either have a micro lot of 0.01 up to 0.09. okay, so 0.01 up to 0.09. okay, so when you enter, let's say 0.09, all right, you are still within the micro lot space. Once you enter 0.1, then it means you are actually using a mini lot. Okay, so we have a formula for calculating how much money that you are willing to make, or how much money you are willing to lose on the market, using any of these lot sizes that I have mentioned right now. Okay, so now that is the next slide over here. How am I going to calculate my gains and then my losses? Okay, so our gains or our losses will be calculated by the lot size that you are going to use, and the lot size will be dependent on the account size. Okay, your account size. Okay, so as we are also looking at making money, we also need to make sure that we are applying proper risk management, which we are going to talk about very soon. But before that, let's learn how to calculate your wins and your gains on the market. So you are going to multiply your desired lot size based on your account size, multiplied by 10, and then you multiply by the number of pips, either in profit or in loss. And I mentioned the last time that pips means what? Percentage in points. So which means that it's just the unit of measurement for calculating the changes or the variations of the exchange rate of any currency pair. All right, so in calculating this, mostly the number of pips will be derived from your analysis that you are going to do. Okay, and then the 10 is always constant, and then the lot size we are going to be using will be based on your account size. All right, so for instance, let's say you are selling GBP USD, all right, and you made a profit of 50 pips, and then you used a standard lot. Going back, where a standard lot means you used one standard lot, so which means you entered one lot on that particular account. Okay, how much profit are you going to gain from this particular trade that you entered? So you are going to multiply the lot size, which is 1 over here, by 10, and then you multiply by the number of pips that price actually moved in profit. Okay, so it moved in profit by what? 50 pips. So if you are calculating the monetary value, you are going to get $500 as price moved 50 pips in profit. Okay, so let's say using the same analogy, using the same example, let's say instead of one lot you used 0.1. okay, you use 0.1 or a mini lot of 0.1. okay, so we are going to make that calculation quickly. So we know that the amount will be equal to the lot size multiplied by 10. The 10 is always a constant, multiplied by the number of pips. Okay, the number of pips. So this amount will be equals, so this time around we are using a mini lot of 0.1, so we are going to enter 0.1. I'm going to multiply that by 10, and I'm going to multiply that by the number of pips in profit, which is 50 pips. Okay, and that is going to give you $50. No, $5 US. $5 US. Sorry, $50. Okay, so if you use a lot size of 0.1 on that particular trade, okay, you would know that you are going to have a profit of 50 US dollars. Let me use the trade that I called this morning for you to understand very well. Okay, so you can see that I placed on my chart over here, I placed a risk to reward 2 over here, right? I placed a risk to reward 2 over here. This tool that you see is called a risk to reward tool. It is used to measure how much of potential risk that I'm going to put on a trade, and then how much of potential profit that I'm going to make. So you can see clearly that the gray area over here is my loss area, and then the blue area here is my profit area. So which means I am risking 40 pips. The 40 over here is the 403 that you see. Because gold is very volatile, mostly the numbers for calculating the number of pips is actually higher than a normal currency pair. So when you see this 403 over here, it actually means that what you're actually risking 40 pips. Okay, and then when you see 1292, it means that actually making, or you are looking for a potential target of 129 pips, or let's say 130 pips. Okay, so using this same analogy, because I have critically analyzed my market, and I realized that okay, market would start selling or will start buying from here. I placed my trade around this area, and then I placed my loss level around this area, or my risk or my stop loss around this area. So in case price decides to go against me, all right, when it hits this level, price will stop me out. Okay, so we are going to use the same analogy to also calculate for the amount of money I'm going to risk, and then the potential amount of money that I'm going to make using any of these lot size that I have actually mentioned over here. So let's say I am using a lot size of 1 standard lot on this particular trade, because I know that my stop loss or my risk point in pips is around 40 pips. Okay, and I know that I am using a risk to reward of approximately 1:2. If let's say I'm using 1:2, then it means that I'll be targeting around 120 pips in profit. All right, so in so doing, we are still going to use the same formula which works for both sides, whether to calculate the amount I'm going to lose or the amount I'm going to gain. So in so doing, we're just going to type the formula again. That is the lot size multiplied by 10 multiplied by the number of pips. Okay, so if I'm going to use one standard lot, let's say I'm using 1 standard lot on this particular trade. So if I'm using 1 standard lot, which means it is 1, you can see over here, let me just show you 1 standard lot represented by 1. Okay, so 1 standard lot, you multiply it by 10, you multiply it by the number of pips. So right now I'm calculating the loss that I'm going to make on this particular trade. Okay, so my loss area is around 40 pips, so I'll just type 40. All right, and then that will give me 400 US dollars. 400 US dollars. So which means if this trade goes against me and comes all the way to hit my stop loss, I'm going to lose 400 US dollars. All right, so if I am going to calculate my gains, with my gains, instead of 40 pips, my gains is around 120 pips. Okay, my gain is around 120 pips. So instead of 40, I'm going to type multiply the 10 by 120, which will give me 1,200 US dollars. So if price comes all the way and I hold my trade well enough, and it comes all the way to hit my target over here, I'm going to earn 1,200 US dollars on this single trade. So you can see that the lot size is a determining factor to actually, calculate your gains or calculate what your losses in any given trade. So which also means that the higher the lot size, the higher your returns, and then the lower the lot size, the lower your returns. Okay, so that is it for that. So I'm going to share if you join my Telegram community, I'm going to share the risk management for various account sizes, and then the lot size we are going to use for various account sizes in the beginners course page. Okay, so I'm going to share that one right after the class, so that you can know that, okay, if I have an account size of, let's say, from $50 to $100, how much lot size am I going to use? Or if I have an account size of, let's say, over $100 to, let's say, $500, per risk management, there's an account size or a range of lot size that you should use. Okay, in the same instance, if you have, let's say, over $1,000 of capital, there's also a lot size we are going to use, because we are looking at managing your risk very, very well. That is why it's very important that before you enter any trade, you are aware of how much you are willing to risk, and then how much you are potentially making from any given trade that you have. I hope it's clear. Any questions so far? Any questions? Can we proceed? Good. So let's get back into the slides. So that is it for lot sizes and how to calculate your wins and your gains. Now we move on to the second part of the session, which is market analysis. So this is where you ask yourself, okay, I understand basic forex terms, I know how to buy, I know some basic terminologies in forex trading. Now, how do I analyze this market? What are the steps that I need to take before I can actually be confirmed that I am ready to actually buy the market or sell? Okay, so that is what we are going to talk about, which is market analysis. Okay, so market analysis, we have two types of market analysis. The first one, we have the fundamental analysis, and then the second one, where most forex traders actually implement, is what we call the technical analysis. Okay, so if you can see back on my chart, all that you see over here, I just analyze the market technically, and then I use that technical analysis to predict the future price movement. Okay, so we are not going to talk so much about fundamental analysis, because with fundamental analysis, it's mostly deals with economic data. Okay, so the fundamental analysis mainly talks about the analysis of social, economic, and political factors that affect currencies and what supply and demand. So with the fundamental analysis, mostly what happens is that you look at certain news event and certain event that happens in various economies, because you are dealing with currencies of various countries. Certain key news event that happens or political event that happen can actually affect the currency of that particular country positively or negatively. So an example, we can have inflation rates, we can also have GDP, we can also have employment and unemployment rate. All these factors actually falls under fundamental analysis. Okay, and there is a platform that we use to check these fundamental analysis, and that platform is what we call the Forex Factory. Okay, the Forex Factory. So let me just share the platform with you. forexfactory.com, www.forexfactory.com, forexfactory.com. So that is, I'm typing the website on the chat box. So that is the platform that we use to check fundamental data that may be released at any given moment. Okay, so I'm going to quickly, so it's like an economic calendar to look at various economic data that's going to affect various countries. So this is the platform that we use to check these economic data. Okay, so you can see that all these are just data. All right, so we have the date, that is the day that that particular fundamental is going to be released. We have the time, we have the currency that that particular fundamental is going to affect, and then we have the impact. So the impact over here, you can see various colors over here. So red impact basically means that particular fundamental is going to have a high impact on that currency. Yellow impact means followed by the orange and then the yellow. So the yellow is fairly also, high impact, but on a lower scale than the red folder. And then the yellow folder means medium impact, which means price might fairly affect, that fundamental might fairly affect that particular currency. And then we have that particular fundamental item, and then we also have some figures. I don't want to go too deep into them because mostly looking just at fundamental data, it can, I don't want to overload you with too much information. These are advanced stuff, so just for you to have an overview of how fundamental data actually works. This is how it actually works. If you want more clarity, you can just contact me and then I'm going to show you. Okay, but my main focus for today is technical analysis. Okay, my main focus for today is technical analysis, so I'm going to skip the fundamental stuff for now because of time. So we have interest rate, we have CPI, we have the consumer price index, we have the GDP, how they basically affect the various currencies, and then all that, and then employment and unemployment rate. You can actually research more into fundamental data and how they actually affect the market. Okay, so now let's move to technical analysis. That is what most forex traders actually pay close attention to. And another reason why I skip the fundamental data is that most of the time when you have your technical analysis on point, the fundamental data comes to respect the technical analysis that has been done. Most of the time, it's only on few occasions where fundamental data does not respect. Okay, so the whole idea is that the fundamental data comes to complement your technical analysis. So once you have your analysis done technically, you use these technical tools that we are going to talk about, a few of them that we're going to talk about. You are going to use that opportunity to actually analyze, and then the fundamental will just come in and then increase the volatility of the technical analysis that has been done. Okay, so let's say for example I have made my analysis over here and I'm expecting gold to actually continue to push up. Okay, right now currently it's currently selling. Okay, so it pushed into profit of, let's say, around 60 pips, and then now it's currently selling at the moment, or it's actually dropping at the moment. So currently you can see that gold is approaching my entry level, which is in between my risk reward tool that we see over here. All right, so let's say when I'm trading and then fundamental data is being released, okay, the fundamental data can actually push these whole candles in my favor impulsively and hit my target faster. Okay, that is why sometimes when you have your technicals right, you use the fundamental as an added edge or an added confluence to complement the technical analysis that has been made on your chart over here. All right, so now what then is technical analysis? Technical analysis is the prediction of future price movement, that is the changes in prices or currencies or exchange rates based on information that has been obtained from the past. So there are different kinds of charts or tools that help us to analyze the chart or analyze the market technically. All right, so we have various tools like the support and resistance, we have the candlestick patterns, we have the Fibonacci retracement tools, we have the moving averages, we have trend lines, gray lines, and other technical tools. So we are going to use these technical tools in conjunction with what we see on the chart, and then we are going to have a prediction of the future price movement. So the data that we are talking about is actually the candlestick chart that we see over here. So what we see currently, let me just use a fresh chart. So what we see currently over here is a candlestick chart, and this candlestick chart is actually data. Okay, so technical analysis, what we use technical analysis to do, what we do with technical analysis is that we look at what has happened from the past. Okay, so when you look at this chart over here, you can see clearly that we have certain price levels or price action or movement at certain key levels, whether pushing to the upside or downside over here. And then you see that there are certain reactions that price actually made, that has made from the past. So we are going to use this information, okay, this information that we've obtained from the past to predict what the future price movement, whether prices will continue to push up or price would decline. Okay, so that is basically what technical analysis is all about. Okay, so the major technical tools that we're going to talk about is the support and resistance and the candlestick patterns. Okay, so what you see on your screen over here is what we call a candlestick chart. Okay, so this candlestick chart has I don't know how to put it. This candlestick chart represents various price action or represent areas where price has actually traded. Okay, so before you can understand technical analysis, there's a platform that we use to actually analyze this chart technically, and that is what the TradingView platform. So I think I mentioned it the last time, so I'm going to quickly run us through some of the basic tools that you are going to be using on the TradingView platform. Okay, so if you are with me or you are with your laptop, you can quickly head over to your browser and then you type tradingview.com. okay, tradingview.com, and when you type it, you are going to if this is your first time actually using the TradingView, you definitely have to create an account with TradingView, either with your Google account or with your Facebook account, or you can create a TradingView account with your email. Okay, I have all those details on how to sign up with TradingView in the complete beginners course in the resource session on the Zoom app. So when you check the resource session, I have added a link to the complete beginners class, which talks about how to set up your TradingView, set up your candlestick chart and everything. Okay, so when you sign up on the TradingView, you're not going to see the screen like this. Okay, so you can make some editing, can make some changes to your platform, how you want to make it look. So let's say, for example, you want to change the color of the candlesticks that you see. Right, so the blue candles that you see means the bullish candles, or which means price pushing to the upside, and then the black candles you see means price pushing to the downside or the bearish candles. All right, so you can double click on the candlestick chart and then you can change the color for the bullish pattern, and then the bullish candles, maybe you can change them to red. You see that my candles have been changed to red, and then maybe let's say green. All right, so you have different forms of colors that you can actually customize your TradingView. And then we also have the bearish candles. You can also change them to red or whichever color you want to use. All right, so I love to use the blue and then the black for my analysis. You can also change the entire canvas, where you can have a gradient background, or you can have any background of your choice, whether plain white, or change the color to gray, or whatever you want to do. You can also add your watermark to your TradingView, so you can see that there's a watermark on my screen that is indicating that particular instrument that I am actually analyzing. So you can see that this is the gold chart and has been represented by what? XAU USD. So if you want more information, kindly get to the access the complete course, and then you understand how to set up your TradingView nicely. Because of time, let me just head over to the business of the day. Okay, so like I said earlier on, we're going to talk about the various candlestick patterns, and then some various candlestick patterns, and then some technical tools that you are going to be using. All right, so if you have any questions, you can keep them coming. After the session, I'm going to answer them one after the other. Okay, right. Thank you very much. So let's get back to our slides. So quickly, let me just touch on the types of trading. So we have types of trading. Okay, so we have the position trading. So the position trading mostly done by big institutions and banks. So actually they capture the entire trend of the market. So when you see an entire trend of the market, looking at it over here, you can see that price is pushing to the upside clearly. So with the position traders, they try to capture the entire trend of the market. They try to capture the entire trend of the market. So this kind of trading is mostly done by big institutions and banks, and these trades can be held for more than weeks and even for months. Okay, so they have large capital that can hold position for close to weeks and months. So they pick the inception of a particular trend, and then they hold the trade until price gives an indication of a reversal. Then they are going to close their trade. So when you can see over here is a representation of a position trading. So they pick the inception of the trend when price is about to push either to the upside or downside. This time around, you can see the price is pushing all the way to the upside. So they pick their entry at the inception of the trend, and then they swing their way all the way to the entire trend of the market. And then if they see an indication of a reversal, then they are going to exit the trade. And then one thing about this TradingView platform is that we have various time frames of the chart. Okay, so this one, as you can see over here, we have various representation of time frames. So we can have the monthly time frame, we can have the weekly time frame, we have the daily time frame, we have the 4-hour time frame, we have the 1 hour, 30 minutes, 5 minutes, 3 minutes, and then the 1 minute. Okay, so with the position traders, they mostly pick their entries from the monthly and then the weekly time frame. So you can see over here, this is the monthly time frame. So what it means is that whatever time frame that I'm going to select, all right, it represents that particular time that we have. Okay, so let's say I am on the monthly time frame. Every candlestick that you see over there represents 1 month of price action. Okay, so it actually took one candle for every candlestick you see to be printed on the screen over here. All right, so when, let's say, you have this particular candle, this candle, it took 1 month for this candle. So this is the candle for the month of June. All right, and it is the candle for the month of July. Currently we are still in July, that is why you see that currently it's still trading over there. So when we get to August, whatever price wants to end is going to close it out and then begin another candle. Another candle will begin to form when we enter a new month. And the same also applies for the weekly and any other time frame that we find ourselves. So when you see over, what we see over here is a breakdown of the monthly time frame, which is what the weekly time frame. So every candle you see over here represents 5 days of price action. Okay, so every candle you see over here represents 1 week of price action. The same applies for the daily, the same applies for the 4-hour, 1 hour, and then the other time frames as well. So when you go to the 1 minute, every 1 minute a new candlestick would be printed out. So you can see that this is the current 1 minute candle that is being printed out. So you can see on the timer on my right hand side over here, so we have barely 30 seconds for this particular candlestick to actually close. So right after the 30 seconds elapses, we are going to see that a new candle is going to print out over here. So we have like 10 seconds for this 1 minute candle to close, and once it closes, it's going to start from where it actually closed. So you can see that this candle closed around this area, and then a new one has started printed out. A new one has started and what is being printed out over here. So after another minute, this one too will close, and then another one, and it happens on and on and on and on. All right, so that is it for the various time frames and understanding the various time frames on the trading view chart. Okay, so that is it for position traders. So for the position traders, they mostly look at 4-hour time frame and above. So they look at the 4-hour, daily, weekly, and then the monthly time frame. And then we also have the swing traders. So the swing traders, they don't capture the entire trend, but they look at swing points. When you say a swing point is a point where price creates a new high or a new low. We're going to talk about that later on. Okay, so with the swing traders, they are mostly trading around in between the 1-hour and the 4-hour time frames. So mostly they look at the overall trend on the daily, scale down to the 4-hour for entries, and then sometimes on the 1-hour, and then they try to capture an entire swing of the market. Okay, so let's say for example we can have a trend trading to the upside like this. Okay, you can have a trend trading to the upside. Where is my part 2? Okay, so we can have a trend trading like this. Okay, all right, so once the position trader captures the entire trend, so the position trader actually captures the entire trend. All right, swing traders capture the swing points. So the swing points are points where price starts creating a new high or a new low from. Okay, so you can see that this new high was created from this swing point. This new high was created from what? This swing point. So swing traders try to capture swing points, so from one swing point to the other. So before price decides to retrace, the swing trader would have exited his or her trade, and then maybe another retracement will form, and then he identifies another swing point, enters again, and then price would swing all the way to any level where it wants to enter before there could be another possible retracement, and then price continues on and on and on. All right, so with a swing point, swing traders, they actually capture the swing point of the market, and then they actually look at mostly the daily, 4-hour, and then the 1-hour. Okay, that is so. And then their trades mostly, swing traders, their trades mostly last more than a day. So they can hold trades that can last maximum up to a week. Sometimes it can last for 1 day, 2 days, or maybe a week. That is why they mostly look at the higher time frame, because it takes time for these candles to be printed out on the higher time frame. Imagine being on a 4-hour time frame and you have to wait for an entire 4 hours for one candlestick to print out on the screen. So that is why with swing traders, their trades mostly last for more than 24 hours. Okay, and then we have the next type of traders, that is the day traders. So with a day trader, that is what myself I actually do. I am a day trader, so I actually look for opportunities within the course of the day, which is 24 hours. So this is a faster form of trading, and they will be trading below the 1-hour time frame, although we're still going to make use of the daily and the 4-hour to monitor the entire trend, and then we scale our entry down to 1 hour and below. We find our entry over there, and then we'll be trading within the course of the day. So the farthest or the longest time a day trader will be holding a trade is just 24 hours. So within 24 hours, I'm going to close out on my trade and then wait for the next day for another opportunity. So typically, sometimes with day traders, their trade can even last for minutes, depending on how volatile or how fast the market actually moves in the market. or how price actually moves in the market. Okay, so a typical day trader, you can have trades lasting for either minutes or hours or within 24 hours. And then we have the scalpers. That is, the scalpers is also another form of trading. So they don't look at a higher time frame. They look at mainly time frames from 15 minutes and below. All right, so they only hold trades for seconds and minutes, and then they close. So they have short-lived trades, and then they target small intraday price movement. So the purpose is to make lots of quick trades with similar profit gains, but they let the profit accumulate throughout the day due to the sheer number of trades executed within each trading session. So with a scalper, they can take as many trades as they can within a day, and then their trades don't really last for long. They can hold trades for maximum maybe 3 minutes, 5 minutes, and then they close out. Because of their repetitive trades that they take, they try to accumulate these small trades for a bigger profit gain. I wouldn't advise that as you are starting out you'll be a scalper, because sometimes the trend may be a bit confusing because of how fast the market moves in the lower time frame. As you can see on the chart over here, that mostly some scalpers actually go into the 1 minute and then they look for opportunities in a 1 minute. So you can see that they try to pick movement within this, so they try to pick fast movement over here, right? So they can just enter a trade, within seconds they'll close it out. They find another opportunity, they enter another trade, within seconds they close it out, because of how quick the market really moves around the smaller time frames. That is how scalpers actually make their money. Okay, so they don't really hold trades for long, and it takes an extra skill to be a scalper. Personally, I'm not a scalper, but there are other forex traders who are, typical scalpers. So they can take as many trades as they can within a day. But for day traders, maximum you can take 1 trade or 2 trades within a day. Maximum 1 trade or 2 trades within a day. That is it for the difference between a day trader and then the scalper, right? So that is it for the types of trading. And then the next one, we have the trading view setup. So the trading view setup, like I said earlier on, you can visit the free beginners course, then you can actually set up your trading view very well. Okay, so I'm going to skip this part and then we talk about market structure. But before that, let me just pause for a while and then answer some few questions, then we can proceed to market structure. If you have any questions, you can either type it on the chat box, and then I would respond before we continue. So I'm not going to share the slides, but the resource that I can share with you is the free beginners course. Any questions for me, please? Any questions for me? Any questions? Any questions, guys? Right.
Nana, I think it would be good for us to, or for you to take the questions at the latter part of the
At the
presentation.
latter part,
Since,
okay.
yeah, since I mean, we are all looking at the numbers and it's getting interesting.
Okay. All right. So we are going. This is where we start getting a little bit technical. Okay. So this is where we start getting a little bit technical. Okay. So before you can, so a brief recap. We spoke about market analysis, and then I spoke about 2 types of market analysis, where we have the technical analysis and then we have the fundamental. And like I mentioned earlier on, fundamental analysis make good use of economic data, political events that happens within various countries, and they affect their various currencies. And then we have the technical analysis, and with the technical analysis we are going to use technical tools and data that has been obtained from the past to predict future price movement using these technical tools. And one key thing that you need to understand under the technical analysis is market structure, because we are looking at data or the candlestick chart on the screen. We need to understand the structure of the market. So it is the structure of the market that is going to help you to determine what trading decision that you are going to make on at any given point. Okay, so the market structure defines the market conditions, and it aids traders to know what trading decisions to take. So in the forex market, we have trends that reflect the average rate of change in price over time. So trends exist in all of the time frames. So a trend is one of the most important aspects which traders need to understand. They should analyze which market the currency pair or that particular instrument that they are trading is actually heading. So we have three main types of market analysis. So at any given point, all right, no matter how the candlestick chart looks, whether it looks clear or it looks a bit cumbersome, market moves, or we have three main types of market structure. We have the uptrend, we have the downtrend, and then we have the sideways movement. So it's either market is moving to the upside, right, or market is moving to the downside, okay, or market is moving in a range bound, or is actually consolidating. Okay, it's actually consolidating. So it's either market is moving to the upside. So if market is moving to the upside, basically we have to be looking for bullish opportunities or buying opportunities, because you see that that particular currency or the base currency is gaining value over the code currency. And where price is moving to the downside, it means that there's a decline or there is a loss in value of that particular currency. So either ways, either price is actually or a particular currency is gaining value or losing value, we can still make money no matter the direction that price finds itself. And then we also have the range bound or the consolidating or the ranging market, where price is neither moving to the upside nor downside. So it's actually moving in a sideways movement. So mostly in a sideways movement, we don't mostly trade in a sideways movement. Okay, when market is trading in a sideways, we mostly don't trade because we don't know the direction that market is going. It's either moving to the upside, it's just moving in a range bound. Okay, it's moving in a range bound. All right, so we're going to talk about an uptrend, which I already spoke about. So uptrend signifies a market heading to the upward direction, and it's actually creating a bullish market movement. It's creating a bullish market movement. So for example, we can have clear uptrend like this. All right, creating a bullish market movement. So we have higher, so price actually moves series of higher highs and higher lows, higher highs and higher lows. All right, so we have the inception of the trend over here. It forms a high, it retraces a bit, and mind you, market doesn't move in a straight line. Okay, market doesn't move in a straight line, so it moves up a bit and then it retraces a little bit to form a higher low, that is a swing point over here, pushes up again to form a new high, which is called a higher high. All right, so where is my text? Text. Yeah, text. So we have HH representing higher high, and then HL representing higher low. All right, HL representing higher low, HH representing higher high. So you can see that this level over here is lower than this one. That is why this is called a higher low. That is called a higher high. And the same point, this level is also lower than the new swing point that is going to form, which is what, the higher low, then it forms a higher high, right? H. So it moves on. So as long as market keeps creating new highs in the market, price keeps creating new highs, price is considered to be in an uptrend. Okay, so you can see that price keeps moving, retraces a bit, keeps moving, retraces a bit, keeps moving. That is what, an uptrend. All right, so an uptrend is a trend where market creates a bullish market movement, and in any given uptrend that you identify, most of the time, because the bigger movements are actually moving to the upside, we look out for bullish opportunities or buying opportunities in the market. Okay, and then we talk about the next one, which is what, a downtrend. So with a downtrend, we clearly see, so this is a typical example of an uptrend over here. So you can see price moving series of what, higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, and it moves on and on. And we have the downtrend. That is where it is characterized by a price decline or price moving to the downside, creating a bearish market movement. So as price is moving to the upside on an uptrend, market will be moving or creating bearish movement in a downtrend. So with a downtrend, you can see price forming series of what, lower highs and lower lows. So we have LL representing lower lows, and then LH representing lower highs. Okay, so price keeps forming lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, and it keeps on and on and on and on. Okay, and then we also have the range bound or the consolidation, where price is neither moving to the upside nor downside. Okay, so this is a typical example of a downtrend, price moving series of lower highs and lower lows, lower highs and lower lows. Alright, they also have the sideways movement, that is the range bound, that creates levels of one key technical tool that we're going to talk about, which is support and resistance level. So you can see that this is a sideways movement in a market, and then it's moving within a range. So we have a price ceiling and then a price floor. So that brings us to the introduction of one main technical tool that we're going to talk about, which is support and resistance level. Okay, support and resistance levels. Okay, so using the same illustration, mostly when I'm looking out for buying opportunities in the market, I'll be marking out my swing points, right, or the higher low levels, right. I'll be marking out my swing points or the higher low levels to find opportunities, because I know that at the higher low level, that is where mostly price forms new swing points, and then price will continue back to the uptrend. The same way, if I'm looking for bearish opportunities or selling opportunities in a downtrend, I'll be marking out the lower high levels, the lower high levels, or the swing points levels. So the lower high levels are the swing points of every given downtrend, whereas the higher lows are the swing points of every given uptrend, right? So these levels that I was marking down over there were actually support and resistance levels. So when we say a support level is a level where price fails to create or price fails to go further low. A resistance level is a level where price fails to go further high. So in an uptrend, I mostly look out for support levels because I'm expecting price to push up. So I'll be drawing support levels mainly around an uptrend, and I'll be drawing resistance levels mainly around a downtrend because I'm expecting price to fall. So I draw a ceiling where price will eventually hit and then will drop. The same way, if I'm expecting price to push up, then it means I'll be drawing certain floors that are acting as support levels. Then when price hits on these support levels, then price will start bouncing off and then pushing up. So that is how I got to enter this particular trade. So you can see that I marked out a support and resistance level, a support level over here, okay, and then you could see that when price tapped on it, it started pushing all the way to the upside. Currently it's coming back to an entry, maybe to tap on another level before it will continue. But before it started, we were actually able to fetch some profits before price actually reversed, and then it's now visiting our entry. All right, so deeper explanation of support and resistance level. So a support area is an area where buying pressure could step in. A support area is an area where buying pressure could step in. So therefore it denotes a price level where buyers would come and push price higher. So buyers will come and push price higher. So when price hits a support level, there are certain indications that we need to look out for before you can actually confirm that price is ready to push up. Okay, so just for understanding, so just know that support areas are areas where buying pressure could step in, and the resistance area is an area where selling pressure or bearish opportunities can be found. So it denotes a price level where sellers will come and push price lower, but there are certain exceptions with regard to support and resistance level. The fact that I draw a support level doesn't necessarily mean that price must respect it all the time. We can have instances where a support area can become a resistance, and a resistance area can also become a support. So we can have an instance where a support area being marked, price will come all the way and push. Let me use my illustration. So we can have an instance where a support area can be violated. Price can break below a support area. All right, let me just use a fresh chart so that you can understand clear all this. All right, so let's say you've marked out a support area. Okay, you've identified an uptrend, price is respecting, the support area is pushing up nicely. So maybe you've marked out a support area nicely like this. So we're expecting price to push up. So there are instances where a support area price can break below a support area. So at that instance, this area that used to be a support can become a resistance if price fails to break back into it. Okay, so if price breaks below a support area, that area now becomes a resistance. So at that instant, I wouldn't be looking at buying opportunities again because a major support area has been broken by price, and then I'll be looking for the reversed form of the trend, which is a down movement or a selling opportunity in the market. In the same instance, when you have a resistance area being marked out, the same instance when you have a resistance area being marked out, okay, you can have a resistance area being marked out like this. this is a downtrend. I just marked out a downtrend, and then maybe I marked out a resistance area. Okay, resistance area like this. There's an instance where a resistance area, so all these are what resistance areas. So you can see the price bounced off, pushed down, bounced off, pushed down. It comes back again. It bounces off another resistance area. Okay, and then what? It pushes down. Right. So we have another instance where a resistance area can be broken, and then it becomes a support. So if a resistance area breaks and then price comes back to revisit that area, at that moment that area now becomes a support area. So that area has now become a support area. So now when price hits the support area, then it means that we will be looking for the reversal trade back to the upside. So that is it for support and resistance levels. Any questions for me so far? Any questions? Any questions? All right, no questions yet. So let's continue. So that is it, as I explained earlier on. Guys, I hope I'm not breaking, because I see an indication of my internet. So I see, so this is an area of support. So when price hit the support area, then it means that we are looking for a potential or an area where buying pressure could step in, because we are using the word could because we are looking at a probability or a high chance that price will start buying when price hits a support area. Okay, because you can have an instance, like I said earlier, where price will hit the support area and then price will break below, and then that support becomes a resistance. And this is a typical example of a resistance area. All right, a resistance area. So with the resistance area, we are talking about areas where selling pressure could step in, and then when price hits a resistance area, there are certain confirmations you are going to look out for before price will start selling. So now you ask yourself that, okay, right now I've marked my support and resistance levels. How do I know that price is ready to buy when it hits a support area, or price is ready to sell when it hits a resistance area? And that's what we're going to talk about in our next session, which is entries, how to look out for entries in the market. So when price hits either support area or resistance area, what will be that strong confirmation to confirm that indeed price is ready to buy when it hits a support area, or price is ready to sell when it hits a resistance area? Okay, so that is it for entries. And then with the entries, we talk about the candlestick chart, which I already mentioned. And then we also talk about the two main types of candles. We have the bullish candle, and then we have the bearish candle. So basically what the bullish candle is that a bullish candle is a candle that is represented by what? A bullish, movement to the upside. And then a bearish candle is a candle that is represented by, price pushing to the downside. So as I showed you on the chart, especially on the 1 minute, you could see that at some point price was pushing to the upside, which means that what? It was creating a bullish momentum or a bullish pressure. And then you could also see that at some point price was actually dropping, which also signified that there was what? A selling momentum actually happening at that particular instance. I wouldn't go back into the candles. So that is it for the types of candlesticks. So we have the bullish and the bullish candle, and then we have the bearish candle. Okay, so because the bullish candle is pushing to the upside, mostly the opening price is actually below. So as you can see, this green candle over here, you can see that the opening price is below. It retraces a bit, okay, to the downside, and then the buyers will push price all the way. So these thin lines that you see on this particular bullish candle is what we call the wick. So the wick actually is a representation of an area that price has actually traded. So when price trades around any area, it leaves a trace, and that trace is what we call the wicks of the candles. Okay, so when price visits any new area, it's going to leave a trace. It's just like stepping in a mud. When you step in the mud, you are going to see the footprint of the soles of your feet being seen in the mud. So it's just something like that. Okay, so whenever price visits any untapped area and then it leaves that area, is going to leave a trace over there. So you can see the lowest point that price has actually traded on this particular green candle pushes back up again to come all the way to this high. So this high over here represents the highest point that price has actually traded, and then price eventually closed at this level. So upon closing at this level, it's going to leave a trace at the highest point that it created, and then it's going to close. So this failed green area is what we call the body of the candle. The lowest point of the bullish candle is what we call the open. We have the wick or the lower wick, and then we also have the higher wick. And then the opposite actually happens for the bearish candle. So with the bearish candle, you will see that the opening price is always at the top, and then we have the untapped areas that it visits, which is the high. Maybe the bulls were trying to take control of that particular trade. Price push to the high, to the upside. So if price is pushing to the upside, it's not going to turn red, it's going to turn green because price is pushing to the upside. And then if the bears are stronger than the bulls, or the buyers, the sellers are actually stronger than the buyers, you are going to see that price will start retracing all the way to this, leaving a trace which we call the high wick or the wick of the candle, and then it pushes all the way to the lowest point where it wants to trade, and then maybe the bulls will just push price back a little bit to the upside, and then leaves another lower wick, and then price closes at the area. So the failed area below on the bearish candle, the failed area below of the bearish candle is what we call the closing price of the candle. Okay, and then we have the reason why we need to understand candlesticks is that the charts, mostly we look at the chart, and the chart is made up of what? Candlestick. Okay, so this candlestick gives us information because, like I said earlier on, we are using technical analysis, and the candlestick chart is actually data. Okay, so we need to understand the language of what? The candlestick, and then we use that language to interpret or our trading decision, whether we are expecting price to push up, or we are expecting price to decline, or we are expecting a bullish reaction or a bearish reaction, which is placing a buy order or a sell order. So in understanding that, that's what we call the candlestick patterns. So these candlestick form some kind of patterns around these support and resistance levels. Okay, these candlestick patterns are formed along the support and resistance level that we spoke about earlier on, and then those candlestick patterns gives us that indication the price is ready to buy when it hits maybe a support area, or price is ready to sell when it hits a resistance area. So that is why I have shared the candlestick Bible in the resource tab. So when you check the resource tab, there's an area, there's a document where we call the candlestick Bible. So the candlestick Bible are various candlestick patterns that every forex trader needs to be aware of, because if you don't understand these candlestick patterns, how then would you interpret what the market is doing for you to take that next trading decision? So I'm going to mention just a few, and then we will look at maybe one simple example, then we'll be out of this place. All right, so we have the candlestick patterns that is important to identify or predict the trend of the market. So we have the bullish reversal pattern, and then we have the bearish reversal pattern. So the bullish reversal pattern is used to identify bullish reactions on the market, and then the bearish reversal patterns obviously is used to identify bearish reactions or selling opportunities in the market, right? So just a few examples of the bullish reversal patterns. We have the hammer pattern, and mind you, these reversal patterns shouldn't be just identified anywhere on the chart. They can only be identified when you have a strong support or strong resistance being marked. So let's say, for example, you can see this clear. This is just an example that I'm making. You can see a clear example of an uptrend being formed over here. So you can see price forming series of what higher highs and higher lows. So in drawing an uptrend, we look at what we draw our support levels. Okay, so because we're expecting price to push up, we draw support levels. Okay, we draw support levels. All right, we draw support levels like this. So it is at these support levels that we are going to identify these bullish reversal patterns that will give us that indication or that confirmation that price is ready to push up. So whenever price taps into any level, be it support and resistance, it's going to give you a confirmation before you can actually place a buy or sell setup or buy or sell order. Okay, so yes, sometimes the candlestick chart can be a bit messy, but drawing these key levels, you can know, or drawing these support and resistance levels, you know exactly which area on the chart that you are looking out for your confirmation before you place your trade. Are we clear? Good. So let me just brush us through the time is fast spent. So let me just quickly brush us through the bullish reversal patterns and then the bearish reversal patterns. All right, so the first one is the hammer pattern. So the hammer pattern is just like the normal hammer. You can see the body of the candle with a long lower wick, mostly formed at a support level. Because obviously we are looking for bullish opportunities. So obviously we will be looking at these candlestick reversal patterns at support levels. Okay, so that is how the hammer candle actually looks. All right, so when you visit the chart, you can see certain hammer candlestick patterns that has been formed along the way. All right, so you can see there's one hammer candle that has been formed over here. Okay, so you can see that there's one hammer candle. This looks like a hammer candle. So right after the hammer candle was formed, you see the bullish reaction, price pushing all the way to the upside. So you can have other hammer patterns as we progress or as we continue to monitor the candlestick chart. Okay, so the next one we're going to talk about is the inverse hammer. So it's just like the opposite or the inverted type of the normal hammer pattern, but this time around we are going to see the body of the candle below with a long upper wick. So if this type of candlestick pattern has been formed on your screen or on any support level that has been marked, then it means the price is ready to push to the upside and you are ready to get in on your buying opportunity. Okay, so that is it for the inverse hammer. And then the second one is the bullish engulfing candle. So with the bullish engulfing candle, this is basically formed by two main candles. So we have a small bearish candle that has been engulfed by a bigger or a larger green or green candle or bullish candle or a buy candle. You understand? So when you see two candles where a bullish candle has completely engulfed the gains of the bearish candle at any given support area, then it means the price is ready to push to the upside. Let me see if I can find an engulfing candle, bullish engulfing candle on the chart. I think this is one typical example of, so you can see I marked out a support area over here, and so this one was actually made up of two main candlesticks, if you can see clearly over here. All right, so we had first a hammer pattern being formed. So this was what, a clear bullish confirmation of what, price pushing to the upside, and then right after the hammer pattern we have a strong bullish candle that was what, that has completely engulfed the gains of this candle and even this candle as well. So this candle that was formed over here gives us a clear indication of price pushing all the way to the upside. You can see clearly what, price pushed all the way to the upside like this. So we gain some profit before price eventually reversing, and you can see that because this area is quite strong, anywhere price taps into it, it gives another confirmation for another, another bullish confirmation to push up. So you see another hammer pattern that has also been formed at the support level, and then right after you see another bullish engulfing candle engulfing the gains of this hammer pattern. So you can either choose to enter around this area, you place your stop loss below, something like this. So this is your long position, the gray area is your loss area, you place your stop loss, and then you target a decent risk to reward. We spoke about risk to reward the last time. So the risk to reward basically means how much you are willing to risk for what, a potential or an intended profit target. So let's say you are risking 40 pips and you are making your reward is maybe 1:4. So you are risking 40 pips and then you are making 160 pips on this particular trade, just because you found what, a support area, there was a rejection around this area, and then you found your bullish reversal pattern. And then mind you, because this candle is black over here, it's still a bullish reversal pattern, because the hammer pattern doesn't mind whether it is a green candle or a black candle or a bullish color or a bearish color, as long as that pattern, that hammer pattern, is formed on a support area, that is a strong indication for price to push all the way to the upside. So looking at this, we entered our trade over here, price came all the way, hit our desired target. So if we had entered, let's say 0.1 on this particular trade, then means we'll be making $160 just on this particular trade over here. I hope it's clear. So that is it for the bullish engulfing candle and the hammer patterns So the next one, or the last bullish reversal pattern we're going to talk about, is the morning star pattern, the morning star candlestick pattern. So the morning star is made up of 3 candlesticks. So we have a bearish candle on the left, a bullish candle on the right, and in between we have a smaller candle, what we call the doji candle, a doji candle. So when we say a doji candle, all right, a doji candle is a candle, another name for the doji candle is what we call an indecision candle. All right, so we can have a doji candle something like this, like a cross, or sometimes we can have a candle like this and then a little body between the line, right? So this can be, this is called a doji, this is also called a doji. So mostly the doji candle means an indecision candle. So mostly when price hits any level and it forms a doji candle, it means that price has not decided on which direction it has to go yet. So you are going to confirm by waiting for the next candle that's going to be formed for you to find that momentum that we are expecting. Okay, so with the morning star pattern, we have a bearish candle and then we have a bullish candle, and then in between these two candles we have a doji candle being formed. So whenever you see this being formed on a support area, you can definitely confirm the price is ready to push to the upside. So there are other bullish reversal patterns that you can find in the Candlestick Trading Bible, and that document has been shared on the resource tab so that you can widen your knowledge on these candlestick patterns for confirmations. All right, so next up we move to the bearish reversal pattern. That is areas of resistance where we look out for selling opportunities in the market. Selling opportunities in the market. So whenever you're looking for selling opportunities, obviously you're going to draw resistant areas or price ceilings around any bearish trend or any downtrend. So when you draw your resistance level, price taps into the resistance level, you are going to monitor that resistance level for a bearish reversal pattern that you are going to talk about, and that will confirm that price is ready to push all the way to the downside. Okay, so the first one, just as the bullish hammer, this time around we have the bearish hammer. This time around, just know that it is formed at a resistance area. So the candlesticks mostly look the same, but just that the area that they are formed is what actually creates the difference. Okay, so this time around we can see a hammer pattern being formed at the top, but because it's formed at the resistance area, it's called a hanging man pattern. It's called a hanging man pattern. So this is the bullish, the bearish reversal of the bullish hammer pattern. Okay, so you can see, let me see if I can find some hammer patterns. Let me see if I can find some hammer patterns. Right. Let me see if I can find some hammer patterns. So which means I need to look for a downtrend, and then I'll fish out some hammer patterns over there. This kind of look like a hammer pattern, but this is a shooting star pattern. Let me see if I can find a downtrend. Okay, right, so we have a downtrend here. Right, so you can see we have a downtrend over here. Okay, and then we have price moving in. So price used to be in an uptrend. We had price breaking structure coming down all the way to the downside. So it means that before we could find this whole trade, you will see that what price formed a resistance. There's a resistance area over here. Oh, around this area. Right, so when price formed a resistance, but this, I'm just trying to, okay, I think let me, alright, so I'm trying to find a hammer pattern. This kind of looks like a hammer pattern. Okay, I think I found one. Alright, so we marked our level of resistance here. Okay, and then right below we saw a hammer pattern being formed around here. Okay, we saw a hammer pattern being formed around the resistance area, and then right afterwards you saw that a positive push all the way to the downside. Let me see if I can find another one. Let me see if I can find another one. Okay, I think this kind of looks like a bearish hammer, but hanging man is not really common. Let's continue. Hanging man is not really common. think I can see one here. You can see one here. So we had an area of resistance, and then this kind of looks like a hanging man pattern. Right at the resistance, price pushed a bit, and then price started dropping all the way. So you can see that price failed to break above and continue to the upside. So we have this resistance level, hammer pattern being formed, and then another candlestick pattern, which is the bearish engulfing candle over here, and then we see the momentum dropping all the way to the downside. Okay, so that is it. So we had a hammer pattern over here, we had a hammer pattern formed over here, hammer pattern being formed over here, and then before the bearish engulfing candle dropping price all the way to the downside. So once we have the hanging man, the next one is the inverse hammer, or the bearish inverse hammer, which is called the shooting star of the candle. So with the hammer, or with the hanging man having, you know, the body of the candle at the top, with the shooting star we have the body of the candle below. Okay, so at any given resistance area, all right, at any given resistance area, when price forms a shooting star at a resistance area, it is a clear indication of price pushing, or a clear confirmation that price is ready to push to the downside. And then we have the bearish engulfing candle, which we see a small green candle or a small bullish candle that has totally engulfed, that has been totally engulfed by a bearish candle. So this is a typical example of a bearish engulfing candle, So you can see that a small bullish candle has been totally engulfed by a stronger or a larger bearish candle. So when you see this at resistance zone, so you can see that there was an area of resistance here, price was failing to push up. We had a first confirmation, we had an hanging man pattern over here. So obviously if you were going for short position, you expecting price to drop, so which means the stop loss area would be at the top, and then our profit area will be below. Okay, so if we are not able to enter at the first confirmation, which is the hanging man, we could have waited for a clearer confirmation, which is the bearish engulfing, erasing the gains of this bullish candle, and then you can also enter from here, place stop loss right above the level, and then you target a decent risk to reward. Okay, so that is how we look out for trades in the market. All right, so that is it for the bearish engulfing. And then the last one, the last bearish reversal pattern I'm going to talk about is the evening star. So with the morning star being the bullish reversal, we have the evening star being the bearish reversal. So with the bearish reversal, also made the evening star is also made up of 3 candlestick patterns. We have a bullish candle, and then we have a doji, and then we also have a strong bearish candle. So we have a doji candle that has been sandwiched by a bullish candle on the left and then a bearish candle on the right. And that 3 candlestick pattern can be found at a resistance area, and then it is a clear confirmation of price pushing to the downside. Okay, so these are the main and the most common candlestick patterns or candlestick confirmations that you need to look out for whenever you are placing any trade in the market. Okay, so at this point, if you have any questions, you can draw my attention. If not, then maybe I'll demonstrate one last example, then I'll end the session. If you need more study or more mentorship, you can contact me, and then I can show you more advanced stuff. I didn't talk about other more advanced technical stuff like the Fibonacci retracement, the trend lines. Time will not permit me to talk about all those things, but understanding just the simple support and resistance levels, and then the candlestick confirmation patterns, all you need to do is learn how to draw these levels very well, and then when you price approaches these support and resistance levels, whether in an uptrend or downtrend respectively, you can actually make good use of any trading opportunity when price gets there, and then you can confirm with your either a bullish reversal pattern or a bearish reversal pattern when price gets there to these support and resistance levels. Okay, so if you have any questions, you can type them in the chat, and then I would respond accordingly. Any questions? Any questions? Any questions? Okay, let me check if there are some questions. Oh, no question. No one is asking any question. No one is asking any question. Okay, so let me quickly run everyone through how I mostly look out for. So I'm just going to show you just a simple strategy. Okay, a simple strategy to look out for opportunities in the market. Okay, so you can just write it down. Let me just brush you guys through a simple strategy. Okay, so the first thing you need to do whenever you're about to place a trade, okay, what I do is that I mostly go to the daily time frame because I want to see the overall trend of the market. Okay, so we are going to implement everything that you've actually learned today to actually place a trading decision. Okay, so I'm going to go to the daily time frame, and what I am looking for at the daily time frame is to identify the trend of the market. In identifying the trend of the market, I want to know whether price is pushing to the upside or price is pushing to the downside or price is actually ranging. So when I move to the daily time frame, I will not look at the entire structure on the daily time frame. If I look at the entire structure on the daily time frame, it will take me more than months to find a trade opportunity, because every candlestick I see over here represents one day, 24 hours. So imagine waiting for a whole 24 hours before I can place a trade. It doesn't make sense. So because I'm a day trader, I'm looking for intraday movement. I will just look at the most recent structure on the daily time frame, and in the most recent structure on the daily, that is what I have highlighted over here. That is the most recent structure on the daily. So I forget about everything that is happening on the past and just look at the most recent structure over here. And the most recent structure, what do I see? I see a clear uptrend. Okay, I see a clear uptrend. So you can see a low, you have a higher high, you have a higher low, you have a higher high, you have a higher low, you have a higher low. So I can see a clear uptrend. So this is the area I'll be looking out for to take my next trading decision. Then I move to the 4 hour. So on the 4 hour is where I'm going to mark out my support area. So you can see that I have already marked out one support area over here, and I think there's also another one. So with the marking out of the support areas, you just in your mind's eye look at how structure has been forming. One of the easy ways to identify support area is when you see that price has been visiting a specific level for quite some time now. So you can see that price keeps visiting this area a lot, so which means this area has created a level of support, which means that what price, this area is a strong area on the chart. Okay, so whenever price hits here, you can see there's a rejection. So these wicks that we see over here are rejections. So what I'll do, I'll just mark out my levels nicely, and then I wait for my confirmation in the 1 hour time frame. So on the 1 hour time frame, I'm going to wait for a confirmation on the 1 hour time frame. So as I can see clearly, price has already tapped into my support area and has already given me a clear indication of what, of a hammer pattern being formed, and that is the hammer pattern that has been formed over here. So which means that what, price has already given me a confirmation for what, a continuation back to the upside. So once I see my confirmation, I place my risk reward tool on it, place my stop loss right below the target, right below the key level, and then I target a decent what, risk to reward. Okay, then I play it out. So this is past, past price action. So I play it out to see if I can what, I can have my desired target met. Okay, so you can see the price is pushing all the way to the upside. Price is almost hitting my target, and then what, you see that what, price has what, eventually hit my target. It has pushed all the way to the upside. And how did I know that price was ready to push up? Was because of what, a bullish reversal pattern that has been formed at the support level. A bullish reversal pattern that has been formed at the support level. I had my confirmation that price is ready to push up, and you can see clearly that what, price pushed up, and then my target has already been what, has been hit. So the same thing, you also go into what, a downtrend. You mark out your resistance levels, and then you can see key areas where price has been visiting the most. You mark a level over there, wait for price to get to that level. You look out for any of these bearish confirmations or bearish reversal pattern that has been formed at these resistance levels, and then once you identify any of them using the one that I just spoke about, or the one that you're going to learn in the candlestick bible, then you can execute your trade based on that. I hope it's clear. So this is just a simple trading strategy that can make you a lot of money. Trust me. Although it's simple, there are more advanced stuff. I can tell there are more advanced stuff, but understanding just this simple strategy alone can help you to make money on the forex market. Okay, so if you have any questions, you can just draw my attention. Okay, right, so he said, please, what are some of the security measures to note before entering a trade? So one of the security measures to know before entering a trade is how much are you willing to lose. Before you enter any trade, you need to know how much you're willing to lose. That is why when I started the session, I took you guys through how to know the amount you're going to be risking and the amount you are going to be you are going to be gaining. Okay, because if you don't know the amount that you are going to be risking and the amount that you are going to be gaining, it looks like you are actually gambling in the forex market. And forex market is not gambling. It's just you speculating on the movement of price. Okay, and then you have your risk carefully calculated. Okay, you have your risk carefully calculated before you can enter the trade. So one of the security measures is that you have your system in play, you have a decent stop loss, and then you have a decent risk to reward, which means either 1:2 or 1:3 risk to reward, and then you take your trade based on that. And then you need to apply the appropriate risk management based on the account size. When I say risk management, it talks about what, the lot size that you are going to use. So like I said, I'm going to share the lot size charts with you into the complete beginners class. Complete beginners, this is the complete beginners platform. So you can see that everything I spoke about from yesterday to today, everything has been recorded here. And I think I might also add what we spoke about yesterday and today too on this platform as well. Okay, so that is it for the trading securities. I hope I have answered your question. He said, please, is the 1 hour time frame the same as one HR, the same as 1 hour in some real time, or there's some calculation? No, yes, it's actually 1 hour. It is actually 1 hour. when we see a 1 hour time frame, it is actually 1 hour. Okay, let me switch back to the live chat. Let me switch back to the live chat for you to see clearly. Okay, so currently I'm on the 1 hour time frame. Okay, and then you can see there's a timer on my right hand side. If you can see clearly, there's a timer on my right hand side here. If you follow my cursor, so you can see that currently we have 5 minutes left for this particular 1 hour candle to finish closing. Currently we have 5 minutes left for this particular candlestick to finish closing. Okay, so it's actually 1 hour in real time. Okay, yeah, so you don't need any extra calculation. 4 hours is 4 hours real time, 1 hour is 1 hour real time, 1 day is 24 hours real time. Okay, so you can actually do that without any confusion. Any more questions? Any more questions? Any more questions? Any more questions? Alright, someone was also asking for my contact. I'm going to drop my contacts. Let me drop my contact here. So this is my contact. So I just dropped my contact over there, so you can contact me for more information. And you can also visit the resource tab to join my free Telegram community, and you can also copy signals, and also I also share some updates around the free Telegram community. Okay, so the trading actually starts. So we have various trading sessions. Okay, so we have the Asian session, mostly when market opens a new week, mostly around Sundays, around 9 to 10 p.m. Okay, so the trading sessions are actually grouped. We have the Asian session, we have the London session, and we have the New York session. So we have Asian session mostly around midnight, that is from 10 p.m, 11 p.m, 12 a.m, up to I think 5 a.m. That is when the Asian session ranges. And then we have London setting in around from 7 a.m to I think 12:30 p.m. All right, and then we have the New York session taking over from 12:30 or 1:30 to the close of the day. All right, so mostly market opens around 10 p.m. Sunday, start of the week or the opening of the week, 10 p.m, and then it closes as the day ends. Any more questions? Any more questions? Any more questions? Okay, I have some Q&A over here. The PDF, I can't share the slides with you. Yes, I have a Telegram group. Kindly check the I have a Telegram group. Kindly check the resources, where the resources is. So kindly check the resources. You are going to find a link to my Telegram group. Okay, send us link. Okay, you let me share the link to the in the chat box as well. Let me share the link to my Telegram community in the chat box as well. Let me share the link to the Telegram community. So you can either look for Nana Trades FX on Telegram, or you can visit the link that I'm going to send to you over here. So that is the link to my Telegram community. That's the link to my Telegram community. Oh God. So you can see that the trade that I called is running in profits. It's currently running in profits. The trade that I called is running in close to 80 pips in profits now. So I'm expecting price to get into my desired target over here. You can see the price is running 80 pips in profit at the moment. So I'm updating my community. Updating my community members. Updating my community members. So, are we clear? So, if there are no questions, then I'd like to end the session for now. If you want to contact me, I've already shared my resources with you. If there are anything, so I've sent the link. That's the link over here. I don't know if I can. Hello, Isaac. Please, are you there? Are you on the call? Isaac, please, are you on the call?
Yes, Bernard is here.
Yeah, Bernard, please, can you show the participants where I have shared my resources if they want to reach me, whether through Telegram or WhatsApp.
Yeah, so it is in your session profile. When
Yeah.
you go to your session and then they click on resource,
Alright.
everything is available over there. Even after the session, they can still have access to it.
Good.
So all they need to do is to just click on your profile,
Alright.
and then they'll go to your session, and like we have everything activated over there.
Okay, that's fine. Thank you very much.
Thank
All
you.
right. So I think I've exhausted much of the time. I think we did 2 hours instead of 1 hour. It was still good because at least it's good to learn something new. Because Forex, I don't want to rush. Yeah, it takes time to actually understand. And mind you, this doesn't necessarily mean you're an automatic trader. You need to practice. It takes a lot of practice. You need to have a mentor to actually guide you, and also if you have some other resources that you can refer to either online, you can do that. But if you want to have a mentor to guide you to this journey, you can also reach out to me, and then I will guide you to learn how to trade the Forex market. Okay, so this is just an introduction. Hey, people cannot see the link. Okay. All right, let me okay, so I'm sharing my numbers I'm sharing my number. So it was actually set to just the host and then the panelists. So I just sent my contacts, all right, and then I'm going to share my my Telegram community link to as well. So that is it. I hope you can see now. So I've shared my contact and my Telegram community, and I'm also going to share the free beginner course too as well, the link to the free beginner course as well into the group. So complete beginners. So I'm going to share the link to the free beginners course as well. I'm going to share the link to the free beginners course as well. Yeah, so copy link, and then I share with you. So this is the link to the free beginners course. The link to the free beginners course as well. That's the link. And I think also if you want to register, you don't have a broker, you want to sign up with a broker, I'm going to send a link to sign up for you to sign up with a broker as well. So I recommend EXNESS as a good broker. If you want to start trading the Forex market, you need to sign up with a broker that allows you to trade the Forex market. It gives you the platform for you to trade the Forex market. So you can also sign up with a broker with a link that I'm about to send to you as well. Okay. Alright, so I've sent that one to you. So you can either refer to the chat box or refer to the resource tab on the Zoom app, and then you can access all these trading materials for free. Alright, so Bernard, I don't know if there's anything you want to add. Yeah, you can start with minimum from you can actually start trading with a minimum of $10, but because of the risk involved and all, let's start with 50 because of experience and stuff. Just start with $50. Okay, so you sign up with a link, that is the one.exness link, and then you can deposit $50. But for now, as beginners, I wouldn't advise you start with real money now, but if you are in the session and then you are quite conversant with forex trading, you can start right away with a real account. But if you're a beginner, please create a demo account and then you start practicing. Once you build confidence in the skill, then you can deposit real money and then you can start trading. All right, so guys, I think this brings us to the end of the session. If there are no questions, then I would like to end the session for now. I don't know if Bernard has anything to add. Then we'll close for the day.
I think we are good to go. There are other sessions going on and some upcoming great sessions to save.
Okay.
Maybe we can drop and also join those sessions as well.
Okay.
And let's not forget to keep in touch and also make use of the resources and the links Nana has shared with us. It's been great being on this session. Nana, thank you very much.
You're welcome.
Putting this together.
You're welcome. All right, so guys, thank you so much for your time, and thank you. Is it Online Work Ghana and other associates that made this session possible? So I'm so grateful that you gave me the opportunity to share my knowledge on the forex trading platform, and I hope that whatever you learned, it will have a positive impact in your journey as you start your trading career. So I am also available if you want to contact me. If there's anything you want to know, any clarity, you can just contact me and then I'll be glad to assist. So thank you guys so much for your time, and I really appreciate everything. So I'll end the session and I'll see you guys later. Have a great day, guys. Okay. Bye.
Recording stopped.
Oh God.